Well, one of the hottest topics in investing these days is small cap value. Small cap value has been a known really since the early 90s, but it hasn't come into its own probably the last 5 to 10 years. And in fact, it reminds me in many ways today the way that the S&P 500 was back in the 90s. It was not a big deal until it went through the run probably from 95 to 99 when it made over 28% a year for 5 years. Then it became the topic of discussion and everybody thought they should own it. And we came to the conclusion, by the way, back then, that you really couldn't beat the S&P 500, that it was virtually, except for somebody who might be lucky, was unbeatable. Well, we know differently than that today. But small cap value, I fear, has become so popular that maybe it's ending up in portfolios it shouldn't be, just as the S&P 500 was the year 2000 after it had that huge run from 95 to 99. So as tempting as this asset class is, I want to make sure that you determine that it is in fact right for you. And the question I have, we all know what could go right. We've seen a lot of that information in the financial press, but I want to ask the question, what could go wrong? Well, first of all, anytime we talk about you making an investment, I want to focus on you and what you should know about you. And that is, when you do invest, when are you going to need the money? Because that could certainly dictate whether something like small cap value is appropriate in your portfolio. And what return do you need or do you want to make? Now, we all intellectually understand the difference between need and want. We want to own a house. We don't need to own a house. We want to own new clothes. We don't need to buy new clothes. So you should know what return you need, what you want, and make sure that to the extent that you're going to be looking at small cap value, that it not only fits that part of the formula, but what about how much risk you're willing to take? Because as we all know, there's a big difference between investing in Enron and the S&P 500. Or, as we'll see in a second, there could be a big difference between investing in the S&P 500 and small cap value. Now then, we need to know about the asset class. Remember, the academics have taught us that about somewhere between 90 and 95% of the money that we make on our investments, and I'm talking about diversified portfolios, first and foremost, that profit comes from the asset class. And so we need to know about those returns on small cap value to make the evaluation whether it's appropriate for us. And we need to know not just about the upside returns, but we really need to understand the downside, because I rarely meet somebody who's disappointed because something made a lot of money. I have seen a lot of disappointment when something loses a lot of money. Now, there are things that we know, and then there are things we don't know. I mean, we know a lot about the past history. Textbooks are filled with the history of small cap value and large cap value and all the asset classes that I talk about. But what we don't know is what will equities. Let's forget about small cap value for a second. Let's just talk about equities as an asset class. What's the future premium for equities? What is it likely to be? Well, we don't know. We see long periods of time where there is no premium, and then we see long periods of time when the premium's amazing, life-changing. And so we normally, when we talk about the return on equities, we start with the S&P 500. From there, we'll look at other asset classes compared to the S&P. And the question the academics have spent a lot of time studying is, how much more should small cap value make than large cap blend? That's large cap blend is the S&P 500, basically. we don't know what that premium will be. There are times, just let's start with the S&P 500, like 1974 through 1999, where the S&P 500 compounded at greater than 17%. I think I said 1974, I actually meant 1975, but it wasn't bad even if you included 74 as well, but it got real good after 74, and from 75 to 99, 17.2%, the best 25 years in stock market history. But then from 2000 to 2017, you made less in the S&P 500 than you would have made in government bonds. 5.4% for the S&P 500. Do you think that was a shock to people who had not invested but could look at that 25-year history of returns and kind of just picture themselves retiring early if you could just get one more 25 years like that? You know something? It doesn't tend to happen that way. Now, for what it's worth, during that period of time, the great period of time from 95 to 99, when the S&P 500 compounded at 28.5%, small cap value grossly underperformed. Now, you're not going to feel sorry for the owners here of small cap value because it did compound at 18.5%. So, about 10% less per year. And the conclusion was that the premium for small cap value was gone. By the way, at that point in time, the academics believed that small cap value should make about 5% a year more than the S&P 500 did. And where that came from was the S&P 500 that was comprised or is comprised of larger companies, so there was supposed to be a premium for small, and most of the S&P 500 is growth oriented, and there's supposed to be a premium for value, so small cap value gets the best of all worlds in terms of premiums. But from 95 to 99, that did not happen. And lots of people concluded it's all over. S&C value, small cap value had its day, but isn't this just the way it normally is? About the time that we find out about it, it doesn't work anymore. Well, it turned out then, from the year 2000 through 2017, there was a huge premium for small cap value over the S&P 500. I believe it was around 8%. Now, that's not normal either, by the way. That shouldn't be part of your plan. But what we don't know is how much the premium is going to be for equities in general, and then how much will the premium for small cap value. What will you be able to add on to it? And by the way, I might just mention there are many experts who are predicting very low rates of return for the S&P 500 for the next decade, in the neighborhood of 5-6%. And we know that's not impossible because it's done that now since 2000. But if there is a premium for small cap value, maybe that means you'll be making 7% instead of 5 or 8% instead of 6 because you've added some small cap value to your portfolio. Now, everything goes along just fine for investors as long as whatever it is you get into is going up. But there is something that happens when things start going the other way. Some people say it's because humans think linearly, and they tend to think that kind of the direction that things have been going is going to continue that way. And that happens on the upside, which is what attracts a lot of people near the peaks of market, is the fact that people think it's going to keep going. But it also happens on the downside, because not only do people see it maybe going down and down and down, but they hate losing money. And they want that pain to stop because they don't know what the future's going to bring, so how they're going to make that loss back up. See, as long as you don't have a loss, you're okay. There are people, believe it or not, who will hold a stock for 25 years waiting to break even so that they don't have to take a loss. It's a big deal emotionally. What we don't know about the future is when we go into long, deep declines, we don't know how far it will be, and we don't know how long it will last. You see, if the decline comes in one day and then things are kind of okay, that has one emotional response. It's very different from when it goes down and it stays down and it stays down and it stays down, sometimes for years. That is an emotional bone crusher for a lot of investors. And we don't know what the declines will be like in terms of depth, and we don't know how long they will last. And then the other thing, and this is really a big deal, we can all talk about how things are going to be, and maybe we will be right. Maybe that'll be like winning the lottery. The things that I say will happen actually happen. It may just be good luck. But the other part of the picture that's never included in the story about what some supposed expert says about the future is what is actually in your future. What kinds of things that you don't expect today are going to happen to you? It could be about a job, having it or not. Could be about children needing more financial help than expected. Could be about your health. Those are things we don't know that can have as much or even more impact than just a decline in the market. So we did a table. I love this table. We'll have a link to it along with this video. But that table covers the period from 1928 to 2017. And it looks at large blend and small blend and large value and small value. And it looks at it from 1928 to 2017. And here's what we know about just the two I really want to talk about in this particular presentation about the S&P 500. How did it do? What was its compound rate of return from 1928 to 2017? Well, it was 9.9%. And that, by the way, if you ask people what kind of return do you think the stock market's going to give you, most people will probably say somewhere around 10%. And in fact, going back to 1928, now think about it, that includes a bunch of wars, it includes a depression, it includes all sorts of political problems and energy problems. It includes waiting in line for half a day to get gas. I mean, there's a bunch of stuff happened in that period that you might be surprised that after dust settled that you got a 9.9% compound rate of return. I should mention that number does not include fees. Now, for that same period of time, and both the S&P 500 and small cap value are relatively new. The S&P 500 actually came out formally in 1957. Now, there was a smaller S&P 500 at 400 and even earlier at 100 that goes back a lot further. But really what's happened is the academics have gone through all of the records and determined what the rate of return would have been had you had it in these different asset classes. And remember, large cap blend, some of it's value and some of it's growth. We use the S&P 500, the industry does. Small cap value, on the other hand, there are lots of different ways that people evaluate it and its long-term return. But in this particular study, this is done using the Dimensional Fund Advisor database that goes back to the 1920s, 13.5%. Well, 13.5 versus 9.9, particularly if I'm talking to a 21-year-old out there, that is a big deal. That is life-changing if you actually picked the small cap value for part of your portfolio. I'm not saying you can't have the S&P 500, but by golly, I do want small cap value in your portfolio because at least looking backwards and looking at what are considered kind of average returns or compounded rates of return, both those numbers seem okay. Now, in that study, I talked about the box that shows the long-term return, then it shows the return in 15-year periods, and then it shows returns in 40-year periods. Looked at all of them, going back to 1928. The average 15-year compound rate of return for the S&P 500 was 10.8, for small cap value 16. The average 40-year compound rate of return for the S&P was 10.9, small cap value 16.2. Now, there were 40-year periods and 15-year periods that were better, and there were some that were worse. But this was the average. So what do? My philosophy about investing is hope for the best, but prepare for the worst. It's one of the reasons I worked longer than I really needed to financially, because I wanted to save a little extra in case things were worse than I anticipated that they would be. So far, everything's okay, but I can tell you that I am every day happy that I put in the extra time and save the extra money, because I really believe that the worst will come again. But I'm hoping for the best. But if I'm going to be building a portfolio, hoping for the best but preparing for the worst, I think I got to have a good idea of what the worst looks like. And so in that same table, we show the worst single calendar year for the S&P 500. That was a loss of 43.3%. Now, we're not surprised to find out the loss for the small cap value was higher, because we know that small cap value, particularly 1 day at a time or 1 year at a time or even 5 years, in fact, maybe even you'll see here 15 years, it's more risky. But you know something? If I really believed as a young person that I had the chance to make that extra 3% with small cap value, I would be willing to accept that 55.5% 1 year loss. Now, I don't want you to lock in on that, because I'm going to show you in a minute something I've not shown before when I talk about small cap value, and that's when it even gets worse than a loss of 55%. And looking at the worst 15 years, the S&P 500 actually made 0.6% a year in its worst 15 years, versus small cap value lost 1.9% for its worst 15 years. Now remember, there were a lot of years that it went up. In fact, almost all of the 15-year periods it went up. But by the time you go out 40 years, every 40-year period came away with a profit. In the case of the S&P 500, the worst 40-year period was a gain of 8.9% a year, compounded. Now, yes, there could be a loss of 43% in there, but there were also some gains of 43% or more. And with small cap value, and I love this, the worst 40 years is a gain of 11.6, compounded. That's a huge advantage. You could argue, which is really more risky in the long run, the S&P 500 or small cap value? Well, for the long run, you could say that the S&P 500 appears to be less productive. Now, we could go a step further and say, okay, which is more risky, bonds or stocks? Well, stocks are more risky, but for the long term, it certainly has historically proven to be worth the risk for that extra return. I've written a number of articles about small cap value, and in fact, you can go to All About Small Cap Value on the home page at paulmerriman.com, and you'll find 8 articles and 2 different tables. And one of these tables is entitled The Advantage of Small Cap Value. It is not a table that I put together. Rather, it's the table that a really bright young engineer by the name of Jeff Mattice put together, and I think it tells a terrific story about small cap value. What Jeff did that was different than anything we had done was he looked at all of the major asset classes that you could go back to the 1920s and see their performance year by year, 3-year periods, 5, 10, 15, 20, 30, even 40-year periods, to see how they performed. And what he was looking for was to find out who was number one in each of these particular periods. Now, 1, 3, 5-year periods aren't very important, but I thought it would be interesting to look here at what happened over a 10-year period, all the 10-year periods. He looked at the S&P 500, that was one of the asset classes, and it was number one in 6% of the 10-year periods. But small cap value ranked number one in 45.8% of the 10-year periods. I mean, it was a huge advantage in almost 50% of the 10-year periods. But by the time you got out to 20 years, The S&P 500 advantage shrunk down to being number one in only 1.4% of the 20-year periods, while small cap value ranked number one in 72.6%. And finally, and this is particularly important to the very youngest investors out there, look at the results of 40 years. The S&P 500 ranked number one in only 3.8% of the 40-year periods, but small cap value was number one in 94.3%. It's interesting to note in the table that small cap blend, and that's a balance of growth and value, it was number one in only 1.9% of the 40-year periods. So small cap value, which is rarely seen in 401k plans, is so much better, not only than the S&P 500, but then small cap blend. So this is a way that I think shows so well that small cap value is truly best of breed. So it's historically been great. And everybody in the industry is, quick to say, but we don't know about the future. But here's what I want to spend some time focusing on. If we're going to hope for the best, it's easy to see what we could hope for. We'd probably be willing to even take a little less than 13.5%. If we could get it, we'd love that. But what about preparing for the worst? And I want to take you through some years that were certainly life-changing for our country. And that was the years 1929 through 1938. 10-year period that was just terrible for a lot of investors, non-investors. Most everybody struggled through that period of time. But let me tell you what it was like. Let's say that somebody had made the case for how great the stock market was. By the way, in 1929, because the market had been doing well for years, people were thinking the stock market was a good place to be. They weren't thinking about losses, they were thinking about gains. Now, only about, 10% of the population had investments in the stock market. So it wasn't like today where most people have some commitment to the stock market. But 1929, a loss with small cap value of 37.2%. And that was followed in 1930 by a loss of 43.6%. And that was followed in 1931 with a loss of 55.5%. And that was followed in 1932 by a loss of 10.5%. And finally, when it turned around in 1933 and it was up 125.2%, you're thinking that must have felt great. But let me just make sure that you know, by the time it had lost 37.2, 43.6, 55.5, and 10.5, for every $100 you had in the beginning, you were down to about $14.50. So wouldn't that be great to be able to double from $14 to $28? You're still behind the curve there. Now that, other than breaking a lot of people, that period of time certainly taught folks they shouldn't have their money in the stock market. But things went on. And before we talk about the next period of time, I want to talk about this a little more about this cost to investors of what happened in that 1929 through 33 period. If you were living off the proceeds as a retiree, you're in deep trouble. If you needed money for an emergency, and boy, did a lot of them, you were in deep trouble. And if you needed money for a child's education, I don't think people paid the kind of money then they do now to get education, but if you had saved and now it was time to cash in and put that money to work to educate that child, you could be in deep trouble. So we had this 4 big losses, 29 through 32, then a screaming gain of over 100% in 1933, where you're on your way. Well, you might not have really known in 1934 because you were down by 6.3%. But then a couple of great years in 35 and 36. Up 47.7, up 66.6. And now you're getting the swing of it. You get a feeling that maybe this is finally it. And then, of course, you run into 1937. We know all of this in hindsight. I mean, there's no risk in the past. We know the years we should have been in and the years we should have been out. But in 1937, down 50.6%. And then in 1938, small cap value goes up again. Now, here's what I know about that 10-year period. That if somebody tried to market time this market based on what they had learned from the past, I'm sure they failed. And if somebody was trying to live off of these returns, I'm guessing if they didn't lose all of this money, at some point they sold out and went elsewhere to figure out how to make a living off of their investments. But here's the interesting thing. To some people, it was the best of times. And to some people, it was the worst of times. But for that whole 10-year period, small cap value actually had a compound rate of loss return of 7.1%. A loss of 7.1 if you put money in at the first of the period and didn't add any more money to it. Your $1,000 ended up being worth almost $480, or compounded at a loss of about 7.1. Now that's still a huge loss, no question, but it wasn't as catastrophic in a sense as you might have thought it was, because you had some years it did go up. But there are a group of people who were either lucky enough or smart enough or had a job and had money to actually put it aside. But from 1929 to 1938, believe it or not, instead of $1,000 on day one and ending up with $479, you put $100 a year in over 10 years, it turned out to be a compound rate of return of 10.1% during the worst decade that we've seen. And in the S&P 500, it was not a loss of 7.1% a year, it was a loss of 0.9%. So the S&P 500 performed the way we would expect it to perform. It lost less money than small cap value. And so that would have been good for old people like me. But when you looked at dollar cost averaging into the S&P 500 over that 10-year period, the compound rate of return was 8.1%. So you actually made more money dollar cost averaging into small cap value than you would have dollar cost averaging into the S&P 500, which had done better over that 10-year period. I hope this is a great lesson for young people, that if you're going to have to go through bad times early on as an investor, you want them to be as bad as they can get. Now, you don't want to be putting your money in one company. You want to be in a diversified portfolio. I'm not recommending that you go whole hog on the risk factor, but if you stay diversified and the market goes down and then it kind of recovers, the odds are you're going to be in pretty good shape. Now, I said it before, there is no risk in the past, but there is in the future. We don't know. It might have been for many more comfortable to trust the S&P 500 in the future after that 10-year period from 1929 to 1938. But what happened for the next 30 years? From 1939 until 1968, the S&P 500 compounded at 12.3%. Small cap value, 19.1. An amazing period. By the way, an amazing period for both the S&P and small cap value. So let me just make some general comments about what I've learned from looking at these returns on the upside, on the downside. I'm a believer that for retirees or people close to retirement, we have to think about defense at every level that we know. I want you to stay liquid. I want you to be able to invest in things that if you have to, you can get out of. Guess what? That's defense. I want you to be in investments that have low expenses. That's defense. I want you to be invested in a way that taxes are low. Defense again. I want you to spread your money amongst all the major asset classes. I'm speaking now in terms of equity. I want you to have the range of equity asset classes so that almost no matter what the market does, you're not going to be at the risk of having too much in any one asset class. Remember, while the S&P 500 from 75 to 99 compounds at over 17%, for the next decade it lost 0.9% a year. I don't want you to have all your money in anything that, particularly in equities, that's going to lose for 10 years. So I want massive diversification at every level. But young investors, I'll take the stand for defense in every area that I know, with the exception of one. And that is, I believe that young investors can take the risk of owning a few asset classes early in their investing career. That could be in my own particular case. I have one portfolio, my Roth IRA, that is not for my life. It's for much younger people. It's all value. It's big value, small value, U.S., international, emerging markets, all value. I've left out the great growth companies because in many ways that portfolio is being built the way I would build a portfolio for a 21-year-old. So I hope this gives you a better perspective of not just the upside potential of small cap value, but the downside risk and the importance of not overcommitting to small cap value if you're into or close to retirement, because it is more aggressive. And we don't know what happens next. I hope you will pass this video or this podcast, we're doing it both ways, to some young people that you know, and make sure they get the links to those the articles. Thanks for watching, thanks for listening, and by the way, I would love some feedback from our regulars on what they think of doing presentations in this video format. Thanks again for watching and listening.